The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
So the odds are, if you're watching us, you qualify as a consumer.
Correct.
If you don't qualify as a consumer, you're not going to be watching anything, most likely.
Not going to matter. Yeah.
So consumers like us, like you, like our families, basically we drive the economy. Now, the government wants to tell us how to drive it, but there are
Always,
certain,
right?
there's only certain things they can get away with,
Right.
empowering us, forcing us to do things that we may not want to do or know in our best interest. But at the present time, with all the fears about turning into a recession and high levels of debt that have been reported for the last year and a half, basically, those issues are being resolved. Inflation, while it has been a problem and remains so, is also driving wages higher. And with higher wages, people's confidence about their financial condition has improved a whole bunch over the last year. And so credit card debt's up. But if credit card debt's up and I have more income, I'm not losing sleep. I'm losing sleep when my credit card debt's going up because that's how I'm paying my bills. And that's not the reality in today's world.
JP Morgan Chase and Bank of America, they've been coming out on earnings season here talking about the health of the economy. And one of the things that they're pointing out is that, first of all, we always have been and still are. Our economy is driven by consumers. 68% of our GDP comes from consumer spending. And, if you think we're finally going to have that recession in 2024, you have to think that Americans are going to stop spending, that's what's going to have to be curtailed. And right now, that is not happening. Jamie Dimon at JP Morgan said that the labor market's very strong. Everything else being equal, that means we have strong consumer credit. And so that's how they see the world right now. They think everything is doing well, spending is going well. And like you said, now, while credit balances are increasing, they're increasing from nearly all-time lows during the pandemic. So when everybody got the stimulus checks, cleaned up their balance sheets, so we're coming back to a more normal level of credit, which at this point is not worrying the banking system at all. Of course, they think it's great. They love for you to use that credit card. We have no problem using credit cards as long as you pay them off. You don't want to carry that big balance. That's what really begins to sink your personal balance sheet. You don't want the balance on there. But both JP Morgan and Bank of America think with consumers still spending, the economy is going to remain strong and the economy is going to remain looking pretty good right now.
So one of the big fears post-COVID was that after the government gave everybody, most everybody, a bucket load of money, and the Fed pumped a whole bunch of money into the markets, that we would use that money, and we did. We spent it like never before.
Correct.
And the assumption has been, well, we're going to run out of that money. It's not going to be here to continue supporting the economy. But in fact, it hasn't all been used up. As wages have risen, people did spend money, but they're a lot more cautious. They're not disrespecting the need to stay liquid in their own household accounts, and businesses likewise. I mean, we've had a business client who, because of the payroll credit issue, by the time everything got done and they didn't have to pay it back, said we've never, as a business, had this much cash reserve in the decades that we've existed profitably.
Correct.
So we actually have seen responsible use of excess cash. Now, a lot of that money is still available for investing. As the market continues to reach new highs, we're going to find the FOMO effect coming back. That's fear of missing out. So far, most of the buying in the market is still dominated by professionals and institutions. The retail investor is looking at 5% interest rate, and after losses in 2020, losses in 2022, they're saying, hey, 5% is not so bad, and I can sleep with that. But when you see another couple of years of market advance that are in the high double digits, you're going, or at least say the high teens and low 20s, if those continue to recur, that 5% is not going to look so attractive. And the retail investor is going to start dumping money out of its bond portfolio and back into equities.
Correct. And that consumer spending and tied to that as a job market is very, very strong, and consumer spending is staying high. Bank deposit is staying high, and those are all working against the poor Fed trying to get inflation under control. They want to see that those numbers change. They want to see unemployment go up. They want to see spending curtailed, and that's not happening. And so there's a bit of a conundrum at the Fed because those numbers are moving in a bad direction for them as far as getting inflation back under control. Even though it's moving in the right direction right now, we're not at the 2% they're looking for. So they're hoping that slows down, but right now, boy, there just isn't any sign of it. The consumer spending is strong. The employment numbers are strong, and we're still spending like crazy. And that's, it's a great sign for the economy. May make it tougher to get inflation down sooner than later.
Well, especially because there is an issue with liquidity that can have an impact on the market. It did back in 2019. Sure. And with the Treasury having to issue new debt to keep the government alive and floating and paying its bills, to avoid what is presented as a catastrophic event if the government shuts down for a day or
right.
two.
Always makes me feel better. But anyway, yeah, that's
Treasury's issuing a ton of money to meet with all the new spending bills, and they're having to issue it on a short-term basis. And part of that is probably an assumption that short-term rates will come down and they'll be able to roll it over and the interest expense will then back off a little bit. But one of the other realities is the number of buyers showing up to buy long-term Treasury debt has been shrinking. And
correct.
It used to be the major buyers were China, Japan, and the European Central Bank. Now, hedge funds, high frequency trading firms have become the major buyer. And in fact, the last auction, the long-term treasuries didn't sell as expected, and the major banks, who are the primary brokers for treasury, had to buy more than normal. They normally end up buying 10 to 15% of the issue. This last auction, they had to buy 25% of it. It's because there's insufficient liquidity in the system. That will cause the Fed to drop rates before inflation is under control. And once they start doing that, they have to quit tightening the QT, the balance sheet runoff, and they start easing again. That's inflationary. So the rate cut situation, the rate cut bet for some time later this year is probably a decent bet. But with that, the follow on is that markets go higher. So we're looking, and particularly with the AI introduction into massive parts of industry, what we see is probably a bull market that lasts longer than the tech bubble did. I mean, we had a tech boom that ran around 20 years. This bull market may well outlast that one because of all the innovation that will be added into the financial easing issues that the Fed eventually will be forced to bring to the table.
That's correct, and we're just at the very front end of that. And we're in such a unique situation right now in the economy. So many people have a low interest rate locked in on their mortgage, which is their largest debt and their biggest the biggest amount of money they have that is interest rate sensitive. It's locked in at a low interest rate. So all of these, the rate increases didn't really affect them that much. They still have availability to regular credit. They're still employed. They're all getting paid. That's pretty healthy. They're looking pretty good, and that's why the stability's been there on the spending side. That's why the economy is still humming right along, and that's actually a good sign for another leg up in a bull market, and then you add in all the productivity gains and the new business opportunities that are gonna come with AI, which seem to be almost limitless. There's almost nothing it looks like that can't be touched by artificial intelligence, and where that whole technology is going to go. And so we're in a pretty good state economically, a solid foundation right now, and we're quite frankly potentially ready to just take off again on another huge run up. So it could be very, very good. Does that mean things have to go that way? Nope. Could we get a recession? Absolutely. Could we get a bear market? Absolutely. All those things can still happen. It's just that it's going to need maybe some more help to get them there, because things are looking pretty solid right now.
Well, one of the big changes that's happening is in investment portfolios, because the standard portfolio is broadly diversified across global markets, and global
Correct.
markets are suffering under the advancing pressures of the US economy. China has been a major economy, a major driver of global wealth, and particularly in emerging markets. That economy is struggling with how to stay out of deflation. They are struggling with an entry into what we saw happen in Japan in the 1980s. They reached a point where there was just no more growth, and they've struggled for 3 decades trying to get consumers reignited in their economy, and they're not, and they have the dearth of babies. And China has a
And
bigger
and
problem.
you didn't hear that wrong, folks. Don just said 3 decades. That's a
That's right.
big, that's a long time, and that's a huge problem. And that's what China's trying to sidestep.
And it's actually too late for them, because they have had a one baby policy, and the babies that were
Yep.
favored were boys. So they've had a very high abortion rate. And now they have so many old people who become burdens on society, don't have incomes of their own. Government has to support them. They are not, they have so many people in the urban areas, and not enough young people. One of the
Correct.
reasons they have a big military is because that's the way you can control uh, teenage and 20-year-old males with high testosterone levels who can easily get into a fight. but but there's not enough women to marry to domesticate them and to
Correct.
solve the lack of babies that they need for their economic turnaround. So that's going to damage those standardized modern portfolio theory portfolios, where you want to have global asset exposure for diversification. But you do that, and you do it into areas that are already compromised economically, and to some extent unable to integrate the AI that we're going to see in the United States, and to some
Right.
extent Europe. But we as a country are entering into the same problem. We've had a couple of years where our birth rate is below replacement. That's one of the arguments for immigration, but
Correct.
there's a difference between immigration and illegal entry. Uh,
No
in
borders. Yeah, that's a different situation. Yeah.
those are entirely different. One is a benefit, and one is a substantial detriment, as we are witnessing in our own country. Do you have anything else to add to this, Perry?
No, we're good. It's actually just another, like I said, another one of those situations where right now things are looking pretty good. As long as the economy keeps humming along, risk assets should do fine, even if things get dicey. So it's we have a bit of a bit of support that we haven't had in the past couple of years, saying, hey, you know what, this economy is very strong right now. People are in good shape. The employment rate's in good shape. It's pretty nice, and it's still important to pay attention going forward, because things can still get sideways in a heartbeat, with as quickly as things change in the economic front, and just the global front these days. But right now things are looking pretty good.
Well, the volatility is not going away. You just kind of
Correct.
alluded to that as a nuance. And one of the things that's interesting is that bond market volatility. This is the safety valve for most people's portfolio.
Yep.
Bonds are actually more volatile than gold. This doesn't make sense historically. This is back to our discussion about PEs don't make any sense on the things that are actually winning in the market.
Right.
So if you're concerned about the volatility in your portfolio, you got to pay attention to your bond market first. Things right now are going through an adjustment period, and nobody knows how it's going to end up. But all the foundation for a major advance of extended time frame is being built right now, and it looks quite promising for forecasters.
Correct.
We don't forecast. All we do is look what's happening, and we deal with the reality of current prices and the positions that we hold or are watching to hold in our portfolios. You want to talk to us about that? Give us a call. The phone number's coming up. The email's there. We'll be glad to talk with you or send you an analysis of your portfolio without charge. We look forward to the next time you're with us. Have a great day.